You're scrolling through Twitter at 11 p.m. on a Tuesday, which is honestly becoming a bit of a habit at this point, and you see it. A decent three-bedroom house, nothing fancy, maybe needs some paint, but it's got a yard and isn't falling apart. The price? $300,000. And for just a second you think, could I actually do this? Then you open the mortgage calculator, punch in some numbers, and that little spark of hope you had, it just evaporates because the monthly payment that pops up feels completely disconnected from your actual life, from your actual paycheck, from your actual reality. And you close the laptop feeling like homeownership is this thing that exists in some parallel universe where money works differently. My name is Synth, and I spend way too much time thinking about money, human psychology, and why the gap between what we're told is affordable and what actually feels manageable in real life keeps getting wider and wider. And here's the thing about a $300,000 home in 2026. It's not actually an expensive house anymore. In most markets, that's entry level. That's the starting point. But the math behind who can realistically afford it, that's where things get really interesting and honestly pretty uncomfortable for a lot of people. Because what I'm going to walk you through today isn't just about calculating what salary you need or what your debt-to-income ratio should be. We're going deeper than that. We're going to look at the actual financial profile of someone who can comfortably afford a $300,000 home in 2026. And I think you're going to be surprised, maybe even a little frustrated, by how much has shifted in just the last few years. But more importantly, you're going to understand exactly where you stand, what's actually holding you back if you're not there yet, and what levers you can actually pull to change your situation. Let's start with the number everyone wants to know. What salary do you actually need to afford a $300,000 home? Now, the traditional rule, the one your parents probably followed, the one that's been around forever, is that you should spend no more than 28% of your gross monthly income on housing. It's called the 28-36 rule, and basically it says that your total housing payment shouldn't exceed 28% of what you make before taxes, and all your debt payments combined shouldn't be more than 36%. So if we work backwards from a $300,000 house with today's interest rates hovering around 6.5% to 7%, which, I know, it's painful compared to the 3% rates people were getting a few years ago, your monthly payment is going to be somewhere around $2,400 to $2,500, and that includes your mortgage, property taxes, homeowner's insurance, and probably PMI if you're not putting 20% down, which most first-time buyers aren't. Now, if $2,500 is 28% of your gross monthly income, you need to be making about $8,900 a month. Multiply that by 12, and you're looking at roughly $107,000 a year. That's the salary you need to technically qualify for this house using conventional lending standards. But here's where it gets real, and this is something nobody really talks about enough. Qualifying for a mortgage and actually affording a mortgage are two completely different things. Banks will approve you based on ratios and credit scores and documentation, but they don't know that your car is making a weird noise and probably needs $1,500 in repairs. They don't know that you're helping your mom with her medical bills. They don't know that you, like a normal human being, occasionally want to go out to dinner or take a vacation without having a panic attack about money. So while $107,000 might get you approved, the reality is you probably need to be making closer to $120,000 to $130,000 to afford this house comfortably. And by comfortably, I mean you can make the payment, maintain the house, save for emergencies, and still have a life that doesn't revolve entirely around your mortgage. Now, if you're sitting there thinking, wait, I need to make 6 figures just to buy a $300K house? Yeah, you're starting to see the problem. Because the median household income in the U.S. is around $75,000, which means the average American household, by these numbers, cannot comfortably afford what we're now calling a starter home. Let that sink in for a second.
But salary is just one piece of this puzzle, right? Let's talk about the down payment, because this is where a lot of people get completely stuck before they even start looking at houses. The standard advice you'll hear everywhere is to put down 20%. For a $300,000 home, that's $60,000. And if you're someone who's been trying to save while also paying rent, paying off student loans, dealing with inflation, and just generally existing in 2026, saving $60,000 feels about as realistic as saving $1 million. It's this enormous mountain that keeps getting taller because while you're saving, home prices keep going up. But here's the thing, you don't actually have to put down 20%. There are FHA loans that let you put down as little as 3.5%, which on a $300K house is about $10,500. There are conventional loans that accept 3% down. There are VA loans for veterans with 0 down. So the barrier to entry is lower than most people think, which sounds like good news, right? Except, here's the catch. When you put down less than 20%, you have to pay PMI, private mortgage insurance, which is basically you paying extra every month to protect the lender in case you default. It usually adds another $100 to $200 to your monthly payment, sometimes more. So now that $2,500 monthly payment we talked about earlier, it's actually closer to $2,700. And that math we did about needing $107,000 in salary, now you're looking at needing even more. And honestly, this is one of those situations where the rules feel like they're designed for a version of America that doesn't really exist anymore, because the advice to save 20% down was created in an era when houses cost 2 to 3 times your annual salary. Today, a $300,000 house for someone making $100,000 is 3 times their salary, but in many markets, that same person would need to spend $400,000 or $500,000 to buy anything at all, which pushes that ratio to 4 or 5 times their income. The game has fundamentally changed, but we're still using the old rulebook. Now let's talk about something that doesn't get nearly enough attention, your debt situation. Because you could be making $150,000 a year, have $50,000 saved up for a down payment, and still not qualify for a mortgage if you're carrying too much debt. Lenders look at something called your debt-to-income ratio, your DTI. They add up all your monthly debt payments, student loans, car payments, credit card minimums, personal loans, whatever, and divide that by your gross monthly income. Most lenders want to see a DTI below 43% and ideally below 36%. So let's say you're making that $107,000 we talked about earlier. Your gross monthly income is about $8,900. If you want to keep your DTI at 36%, your total debt payments can't exceed about $3,200 a month. Now, if your mortgage payment is going to be $2,500, that leaves you only $700 for all your other debt. But what if you've got $400 a month in student loans, $350 for a car payment, maybe $100 in credit card minimums? You're already at $850, which pushes you over that threshold. And just like that, you don't qualify. Or you qualify for less house, or you need a bigger down payment to lower your monthly mortgage payment. And this is where I see so many people get frustrated because they're doing everything right. They went to college, they got a decent job, they're paying their bills. But the debt they accumulated along the way is now blocking them from building wealth through home ownership. It's like running a race where every mile you complete, someone adds another mile to the finish line. The brutal truth? If you want to afford a $300K home in 2026, you probably need to get your non-housing debt below $500, ideally lower, which means aggressively paying down student loans, avoiding car payments if possible, and keeping your credit cards paid off. I know that's easier said than done, but it's the reality of the system we're in. Let's shift gears for a minute and talk about credit score, because this is one area where you actually have more control than you might think. Your credit score directly impacts your interest rate, and even a small difference in interest rate can have a massive impact on affordability. Let's say you're looking at that same $300,000 house. If you have a credit score of 760 or higher, you might get an interest rate of 6.5%. But if your score is 680, you might be looking at 7.2% or higher.
That might not sound like a huge difference, but here's what it actually means. With a 6.5% rate, your monthly payment might be $2,400. With a 7.2% rate, it's closer to $2,550. That's an extra $150 a month, or $1,800 a year, or $54,000 over the life of a 30-year mortgage. You're literally paying $54,000 more for the same house just because your credit score was 80 points lower. So if you're not quite ready to buy yet, one of the smartest things you can do is focus on your credit score. Pay your bills on time, every single time. Get your credit utilization below 30%, ideally below 10%. Don't close old credit cards because length of credit history matters. Check your credit report for errors because mistakes happen more often than you'd think. This is one of those areas where a little bit of effort can legitimately save you tens of thousands of dollars. And honestly, improving your credit score is often easier than saving an extra $30,000 for a bigger down payment. Now, here's something that's going to sound depressing, but I think is actually important to acknowledge. Location matters more than almost anything else. A $300,000 home means something completely different in Cleveland than it does in San Francisco. In some markets, $300K gets you a 4-bedroom house with a 2-car garage and a yard. In others, it gets you a 1-bedroom condo with shared walls and $400 a month HOA fees, or it doesn't get you anything at all. And this creates this weird situation where the question, who can afford a $300K home, has a completely different answer depending on where you live. In lower cost of living areas, someone making $80,000 might be able to swing it comfortably. In high cost of living areas, even someone making $150,000 might struggle because that same person is also paying $2,500 a month in rent right now, which makes saving for a down payment nearly impossible. I think this is one of the reasons housing feels so psychologically exhausting for so many people. It's not just about money, it's about choosing between the life you want and the house you can afford. It's about wondering if you should move to a place where houses are cheaper, but you don't have family or friends or job opportunities. It's about feeling like you're constantly making compromises and still coming up short. And honestly, I don't have a perfect answer for this one. Geography is one of the biggest levers in personal finance, but it's also one of the hardest to actually pull because it affects your entire life, not just your bank account. Let's talk about the hidden costs, because this is where a lot of first-time buyers get blindsided. You've saved for your down payment, your credit score is good, your debt is under control, you get approved for the mortgage, you buy the house, and then the water heater breaks, the roof starts leaking, the HVAC system dies in the middle of summer, and suddenly you're staring down $5,000 in repairs that you didn't budget for because you spent everything you had on the down payment and closing costs. The general rule of thumb is to budget about 1 to 2% of your home's value per year for maintenance and repairs. For a $300,000 home, that's $3,000 to $6,000 a year, or $250 to $500 a month. And that's on top of your mortgage, property taxes, insurance, and utilities. Most people don't think about this when they're calculating affordability, but it's real. Houses are not like apartments where you can just call the landlord when something breaks. You are the landlord now, and things will break, not might, will. So when we talk about who can actually afford a $300K home, we're not just talking about someone who can make the mortgage payment, we're talking about someone who can make the mortgage payment and still have enough left over to build an emergency fund, maintain the house, and handle the inevitable surprises that come with home ownership. That's why I keep coming back to this idea that you need more income than the basic qualification formulas suggest. It's not just about getting approved, it's about not being house poor, where you own a house but can't do anything else. Here's a reality check that I think is worth sitting with for a minute. For a lot of people, a $300,000 home in 2026 just isn't realistic right now. And that's not a personal failing, it's a systemic issue.
Wages haven't kept up with housing costs. Student debt is crushing an entire generation. Interest rates have more than doubled in the last few years. Saving for a down payment while paying rent that's also been skyrocketing? It's like trying to fill a bucket with a hole in the bottom. But here's what I also know. Understanding exactly where you stand, knowing the actual numbers, the actual requirements, the actual challenges, that's the first step toward changing your situation. Because once you know what the target is, you can build a plan to get there. Maybe that means focusing on increasing your income. Maybe it means aggressively paying down debt for the next 2 years. Maybe it means improving your credit score by 50 points. Maybe it means moving to a different market where $300K goes further. Or maybe it means accepting that you're not ready yet, but you will be. And that's okay. The people who successfully buy homes in this market aren't necessarily the ones who make the most money or have rich parents or get lucky. They're the ones who understand the system, make a realistic plan, and execute it patiently over time. They're the ones who know that qualifying for a mortgage and affording a mortgage are different things, and they plan accordingly. So who can actually afford a $300,000 home in 2026? Based on everything we've talked about, here's the realistic profile. You probably need a household income of at least $120,000 to $130,000 to afford it comfortably. You need at least $10,000 to $15,000 saved for a down payment and closing costs, ideally more. You need your non-housing debt to be under $500 a month, preferably much less. You need a credit score above 700, ideally above 740. And you need an emergency fund so that when the dishwasher dies or the fence falls down, you're not immediately going into credit card debt. That's not most people. And I think it's important to just acknowledge that directly, because there's this cultural narrative that home ownership is the default path to adulthood and financial security. And if you're not on that path, something must be wrong with you. But the math doesn't lie. The system has changed, and it's left a lot of people behind through no fault of their own. But here's what I want you to take away from this. If you're not there yet, that doesn't mean you never will be. It means you need a plan. It means you need to focus on the things you can actually control: your income, your debt, your credit score, your savings rate, and stop beating yourself up about the things you can't, like interest rates or housing prices or the fact that your parents bought their first house for the equivalent of a used car. The people who build wealth in difficult economic environments aren't the ones who wait for things to get easier. They're the ones who understand the rules of the game, even when those rules feel unfair, and figure out how to win anyway. Not by cutting out lattes or skipping avocado toast, but by making strategic decisions about debt, income, and saving that compound over time. If you're watching this and you're frustrated because you make $75,000 and you have $30,000 in student loans and you're renting a place for $1,800 a month, I get it. You're not in a position to buy a $300K house right now, but maybe in 3 years you could be. Maybe you focus on increasing your income by $20,000. Maybe you knock out half that student loan debt. Maybe you save $1,000 a month for the next 24 months and build up a down payment. Maybe you improve your credit score by 60 points and save yourself $100 a month in interest. These aren't small changes, but they're possible. And they're way more useful than just feeling like the system is rigged and there's nothing you can do about it. Because here's the truth: the system is rigged. Housing affordability is a genuine crisis. But within that rigged system, there are still paths forward for people who understand the numbers and make intentional choices. And my hope is that now you understand those numbers a little better. You know what it actually takes. You know where you stand. And you know what you need to do next. That's not nothing. That's actually everything.